Hello and welcome to all the viewers. Today our subject of discussion is accountancy and we are going to deal with the chapter Fundamentals of Partnership, chapter 1 of class 12. Stay with me, learn with me. I am Preeti Sharma, PGT Commerce, and find out what we are going to deal with today. Today we are going to deal with the topic Partners Capital Account. In the last class we have discussed the preparation of P&L appropriation account. After the preparation of P&L appropriation account, a firm has to prepare its partner's capital account. Partner capital account is nothing but it's a personal account of the partners. Whenever a transaction is done, if it results increase in partner's capital account, then we post the entry on the credit side. If due to the transaction there is decrease in the capital, then we post the entry on the debit side of partner's capital account. So now let us come to the meaning of partner's capital account. You can see partner's capital account can be prepared according to two methods. First is fixed capital account and second is fluctuating capital account. You can see under fixed capital account there are two accounts are prepared. First is capital account and second is current account. As the name suggests, fixed capital account. When we prepare capital account under fixed capital account method, then there will be no change in the capital of the partners. As its name suggests, fixed capital, so the capital will remain fixed. It will change under the special circumstances. The special circumstances you can see in the format. If some partner brings additional capital or if some partners withdraw the permanent capital from the firm, only then the capital can be changed. Otherwise, capital will remain fixed under capital account. Second is current account. Under current account, all the transactions of routine nature like interest on capital, interest on drawing, salary, commission, and the result drawn by preparation of P&L appropriation account will be transferred under the current account. Now let us come to the format of capital account. You can see under capital account there are two sides, debit and credit. On the credit side we will write by balance brought down, that is the opening capital. Secondly, by cash / bank account, that is additional capital. If some partner brings additional capital, then we can write this capital on the credit side because it will result in increase in the capital account of the partner. So we will put this entry on the credit side. Now come to the debit side. On the debit side we have written to cash / bank, that is withdrawal of capital. If some of the partner withdraws the capital permanently from the business, then that will result in decrease in capital. That's why we will mention this transaction on the debit side. From the credit side we will deduct the debit side and we will get the closing capital, that is to balance carried down. The next format is current account. Under current account you will write by balance brought down on credit side, that is the opening capital of current account, and all routine transaction which will result in increase in capital account will be shown on the credit side of partners capital account, like by interest on capital, that will result in increase in the current account, so we will show this entry on the credit side. By salary / commission, if some partner is getting salary or commission, that will also result in increase in the current account, so we will put this entry on the credit side. Lastly, by P&L appropriation, the profit which is arrived by preparation of P&L appropriation account will also be transferred on the credit side because it will also result in increase in partners capital account. On the debit side, we will write to balance brought down, that is the opening capital. If some debit balance of the partner is given, then we will write to balance brought down on the debit side. Second, to drawings. If some partner is withdrawing amount for his personal use, that will result decrease in his current account. That's why we will show this entry on the debit side. To interest on drawing, that will also result in decrease in current account. That's why this entry will also be shown on the debit side. To P&L account, if some losses is given in the question, then we will also put this entry on the debit side, and from the credit side we will deduct the debit side and we will get balance carried down, that is the closing capital. So these two accounts are maintained under fixed capital account. Now let us move to the next account, that is the fluctuating capital account. Under fluctuating capital account, we will prepare only one account, and all those entry which we have divided into capital account and current account, all those entries will be transferred under the one account, that is fluctuating partners capital account. You can see on the credit side, by balance brought down, that is opening capital, by cash, that is additional capital, by interest on capital, by salary oblique commission, by P&L appropriation account, that is profit. All these entry will result in increase in capital. That's why it is written on the credit side. And on the debit side, we have written to balance brought down. If debit opening balance is given, then we will write on the debit side. Then to drawing account, to interest on drawing, to P&L, all these entries will result in decrease in capital. That's why we have written all these entries on the debit side. From the credit side, we will deduct all these entry which is given on the debit side, and we will get the closing balance of the capital. So this was about the format of fixed capital account and fluctuating partners capital account. So we can say there is much difference between the fixed capital account and fluctuating partners capital account. Let us come to the difference between these two accounts. There is difference between fluctuating capital account and fixed capital account. Under fluctuating partners capital account, we prepare only one account, that is fluctuating capital account. Under fixed capital account, we prepare two accounts, that is capital account and current account. The second difference is, under fluctuating partners capital account, we can have debit as well as credit balance, but under fixed capital account, we will always have credit balance. Third, under fluctuating partners capital account, we put all the entries under one account, that is fluctuating partners capital account, but under fixed partners capital account, all the transactions which are of routine in nature will be transferred to current account, and one or two transactions which are of permanent nature will be transferred to capital account. So now let us take one example. You can see there are three partners, ABC sharing profit and losses in the ratio of 3:1. Their capital on 1st January 2011 were rupees 60,000, 40,000 and 10,000. Their drawings were 3,600, 3,000 and 1,800. Interest on capital at the rate of 15%. Interest on drawing is given, that is 450 for A, 350 for B and 200 for C. C is also given a salary of 8,000 and 5,000 per annum respectively. C was withdrawing his salary in addition to drawing. That means when we will calculate drawing, then we assume that C will also withdrawing his salary. Firm earned a profit of rupees 69,600 during the year. Partner desired to transfer 10,000 to journal reserve, prepare P&L appropriation account as well as prepare partners capital account under case 1 fluctuating partners capital account, second fixed capital account. Under fixed capital account, they have also given the balances of current account for A, B and C. So now let us move to the solution of this question. You can see this is the P&L appropriation account. Interest on capital was given in the question at the rate of 15%. We will calculate 15% on 60,000, 40,000 and 10,000, and we will be able to calculate 9,000, 6,000 and 1,500 interest on capital. Then it was given in the question that A and C is drawing the salary of 8,000 and 5,000. We will write this on debit side, that is total is 13,000. It was also mentioned in the question, transfer 10,000 to general reserve. Now move to the credit side. Net profit was given 69,600 and interest on drawing was given on ABC, as you can see in the question, 450, 350 and 200, which we have written in this format, and the total amount is 1,000. From the credit side, that is 70,600, we will deduct all these 3 points, that is interest on capital, salary and general reserve, and we will get the profit which will be transferred to the partners capital account and current account. You can see we have already discussed the format. First of all, we will transfer the opening balance, that is buy balance brought down 60,000, 40,000, 10,000. Then all those entry which will result increase in capital, that is interest on capital 9,000, 6,000 and 1,500. By partner salary 8,000, 5,000 for C. From the P&L appropriation account you have got the result for A 15,550 rupees, for B 10,367 and for C 5,183. All these three items will be transferred on the credit side of partners capital account because it will result in the capital of the partners. Now on the debit side we have written two cash, that is the drawings made by the partners. For A 3,600, for B 3,000 and for C is 6,800 because he is withdrawing in addition to salary of 5,000. Then interest on drawing, that was also given under the question, and you have written on the credit side of P&L appropriation account, that is 450 for A, 350 for B and 200 for C. We have also transferred all these on the debit side of partners capital account. From the credit side we will deduct these 2 points and we will get two balance carried down, that is for A 88,500, for B 53,017 and for C 14,683. Now let us come to the capital account. Under the capital account, that is fixed capital account, so we will just transfer the opening balance and that opening balance will become the closing balance. Now we will prepare current account. On the credit side of current account, first of all we will transfer buy balance brought down, that is the opening capital of current account in A and B. C's debit balance is given, so we will transfer the opening balance of C on the debit side, that is two balance brought down under the column C 1,200. On the credit side we will transfer buy interest on capital, that is 9,000 for A, 6,000 for B and 1,500 for C. Third item, by partner salary, A's salary and C's salary will be transferred on the credit side because it is increasing the capital account. Lastly, by P&L appropriation, we will transfer the profit of P&L appropriation under ABC. On the debit side, we will write those items which will result decrease in the current account. First item is two balance brought down, that is 1,200 debit balance of opening capital. Second is two cash, that is drawing made by A, B and C. Thirdly, two interest on drawing, that is for A 450, 350 for B and for C 200. From the credit side we will deduct the debit side and we will get the balance for A, B and C. This is how we prepare current account. So student, today we have discussed the meaning of partners capital account, types of partners capital account and its preparation. Hope you must have understood the topic. Thank you. Have a nice day.